Hi everyone, welcome to today's lecture. We're going to be doing the end of chapter 6 today, involving international trade. In particular, we're going to be doing quotas. We did tariffs the other day, and we're going to finish off by doing quotas, which is another form of protection. And then following that, I'm going to start on chapter 7. I anticipate getting through about the first half of chapter 7, maybe today. And I think we'll be able to finish off chapter 7 next Tuesday. That's the first lecture of week 8. And then in the second lecture of week 8, I will do chapter 8. And then in week 9, I would assume that we probably do chapters 9 and 10 in 1 week. Chapter 9 can be a little bit longer than chapter 10. If we need to do lectures in week 10, there'll only be one lecture. So we'll just see how we're going for time. We've got plenty of time. We've certainly got week 10 available, but we may not need a lecture in week 10. So we'll just see how we're going. Now I've put a slide up for you. I'm going to put a slide up for you now, and this slide is for the academic literacy workshop, and it's you can see the live version of it next Thursday at 9 a.m. Now it does clash with our in-class lecture, but you'll be able to see. You'll be able to watch a recording. It's at 1 to 2 p.m. Excuse me. So it doesn't clash with our lecture. In any case, it will be recorded, and you can watch it later. The link for this is in your announcements, I think. So William has put the announcement up, and you can scan the QR code and get into the lecture that way. I think he's probably also put just a link that you can click in Moodle if you wish to attend this workshop. So that's that announcement. So I'm going to then move into today's lecture, which is finishing off in international trade. So I'm just going to slide down to where we got the other day. Come down to where we got the other day. We finished off with subsidies. And today we're doing quotas. Come right down. Okay, so quotas. So this is our topic for today. We're finishing off where we got to the other day. So I'll just talk to you briefly about quotas. We can see that a quota is a quantity limit on what we're allowed to import. So I'll just talk to you more directly about this before we actually get into our slides. The way a quota works is this. Unlike a tariff, where the government puts a tax on an import, and that pushes the price of the import up, and as a result of the price of that import rising, the quantity of imports gets smaller. That's the effect of a tariff. So it does two things. It pushes the price up, and then it makes the quantity of imports smaller, because when it pushes that tax up, the local good becomes more competitive against the import. People then switch their demand back to the local good. So it's a growth in the local industry and a fall in the level of imports because the good got more expensive. Quotas kind of have the same effect, but by the use of a different mechanism. So instead of initially starting with the price of the import, the quota limits the quantity of the import. We know that we have two axes, the price axis and the quantity axis. The tariff works via the price axis. The quota works via the quantity axis. And the way you could imagine this working is this. Imagine at the moment under free trade, we were importing, let's say, 80,000 cars from Korea. I have no idea how many cars we import from Korea. But let's imagine it's 80,000 cars a year. And then imagine the government said, no, you can't import 80,000 cars anymore. You've got to import 50,000. In other words, we're only allowing 50,000, no more. So this would fix the level of imports at a lower level of imports. And because they do that, the slice of the local market that is going to the imported sales would fall. And that would leave a shortage of products because there's less imports coming in. So consumers are finding it more difficult to buy the product. The price of the product would rise and the local supplier would then fill that shortage. So instead of, if we have, 80,000 Korean cars, that falls to 50,000. And then there's a shortage of 30,000 cars. The local producer could come in and produce those 30,000 cars and supply those products to the customer. So it transfers the demand for the import to the demand for the local product. So it's also a form of protection. Now, we can't do that in our country because we hardly have a car industry here anyway. So just about all the cars we drive are imported anyway. But were we protecting a local industry, that's the way it would work. And the way that the government would organise this is to say, last year we had 80,000 cars. This year we're going to only allow 50,000. So we're going to give five licenses, each one for 10,000 cars. And then the local importing companies would have to compete for those licenses. There's only 5 licenses. You can only import if you've got a license. And so that is the way that the government would control the level of imports through the quota. So that's basically the way the quota works. I'm sure the actual mechanism, the real life mechanism, is a little bit more complicated, but that is the concept. So let's go over to our slides then, and I'll talk you through now how these imports are, the import quota is going to work. Okay then. So first of all, we have an import quota, and what are the key words here? The import quota represents a quantity limit on the amount of goods that can be imported. So essentially what it's going to do in the market for goods is that if this is the supply curve by the domestic industry, and then we add to that, we say that the importer is currently importing some as well. So this is the quantity this is the supply curve with the domestic industry plus the imports. At the moment, the level of imports is shown by the red. The government would then say the level of imports has to fall. We're going to only allow a smaller amount of imports. So the actual supply curve, the total supply curve for the domestic plus the imports would move to the left, because now there are less imports being allowed. We've reduced the level of imports by this much. So how many imports would remain? I'm showing that in blue. Instead of it being the level of the red line, which I'm going over, instead of it being the level of the red line, now the level of imports would only be equal to the level of the blue line. So we're going to have less imported products. So essentially, it's a shift of the supply curve to the left. Before we move forward here, I want you to think for a moment, just to revise what we did the other day. I just want to revise. So I'm doing this so you can kind of visualize more easily how this quota is going to work. You'll remember the other day, we've got price axis and quantity axis. We have a domestic demand and a domestic supply. So there's our supply, domestic demand, DD. Our equilibrium normally would be where the dot is. We'd have an equilibrium price. I'm just putting a little dot on the vertical axis and an equilibrium quantity on the horizontal axis. I don't really want to label them because in free trade, we're not operating at that level. In free trade, we're operating down here at the world price. And at the world price, the local firm produces QS and the local demand is QD. And the difference between these two is the level of imports. There's the level of imports in free trade. And then how does the tariff work? The tariff works because then the government adds a tariff, T. The price comes up here to the green line. The new level of demand, right, QD1, is lower because at a higher price, consumers buy more. And at a higher price, producers make more. So this becomes QS1. And now the level of imports is now smaller. You can see the level of imports shown in green is lower than the level of imports shown in red. So what has the tariff done? Let's put summarize the effect of the tariff. First of all, what did the tariff do? I'm going to circle this in blue. What did the tariff do? It raised the price. So the tariff puts the price up. And what did it also do? It reduced the level of imports. And what else did it do? So the level of imports went down. And what else did it do? It increased the supply, the local quantity supplied. So that's a summary of the tariff. Now, the reason I wanted to do the summary of the tariff is because when we apply the analysis to the quota, it's going to do a similar thing. Now, I've got diagram 3 here, but I'm actually going to go one. Yes, I'm going to look at this diagram first before we go to the quota diagram in your textbook. The one that I'm displaying at the moment is the textbook slide. And what this textbook slide is really showing us is this, that we've got a supply curve. Here's our supply curve. That's the domestic supply. So there's no imports in that supply curve. What's the curve to the right doing? The curve to the right, of course, that's the domestic supply plus the imports, plus the quota. So the domestic supply is bigger, we'll call that S1. S1 is bigger than S. S1 is bigger than S because now there's 2,000 imports. That 2,000, that's the imports, that's the quota, that's the amount that we're allowed to bring in. The reason I wanted to start with this slide, which is the textbook slide, is because if we look at this slide, it makes the quota appear to be increasing the supply of goods into the market. Now, of course, it is there is an increase, there is a rise on the domestic output. We've got the domestic output plus another 2,000 imports. But although it's increasing the supply relative to a closed economy, it's actually decreasing the supply relative to an open economy. So I have also drawn up this diagram because if we think about free trade, what's going on in free trade? Remember, free trade is the world price, right? PW. The world price is 15. Let's take that line straight across, and we see that 7,000 is being demanded, 2,000 is being supplied, and so originally in free trade, we've got 5,000 imports, not 2,000. In free trade, we've got 5,000 imports. And then the government comes along and says, we don't want 5,000 imports because that doesn't leave a big enough slice for the local firm. So what we're going to do is we're going to say the level of imports must fall from 5,000 to 2,000. I've given the tick there, 5,000 to 2,000. So what the government actually does when it imposes this quota is that it moves the supply curve from the free trade supply, which is the domestic supply plus the imports. It moves that supply curve, actually moves it to the left because now there is less imports. So the blue line represented the free trade supply curve, but the new orange line, let me draw it in orange, I'll just trace it in red. This line now represents actually a lower level of imports because 3,000 imports have disappeared. So suppliers are not allowed to import 3,000 anymore. They're only allowed to import 2,000. They're not allowed to import 5,000 anymore. They're only allowed to import 2,000. So 3,000 less imports. If we then go down and we look at a clean slide here, what is the effect of this? The effect is to do this. The quota, of course, one effect is that the level of imports fell. Okay, well that's what the quota does. It reduces imports from 5,000 down to 2,000. The level of imports fell. And as a result of the supply curve moving to the left, there's less goods on the market. And as we know, whenever there's less goods available in supply, the price will rise. So now there's not an equilibrium at the black dot, there's now an equilibrium at the red dot, which means that the price has gone up. So the price has gone up, and you'll remember when I started the presentation today with this diagram, I showed you that with quotas, with tariffs, that's also the effect of a tariff, right? They also reduce the level of imports, and they push the price up. The only difference with the tariff is that we're starting with an intervention on the price by pushing the tax up, but with the quota, we're starting with an intervention on the level of imports. So the price rises, coming back to the, yes. So our equilibrium then moves from, as I said, from the black dot, and we'll create a red dot up here, the new level. And so the price will now go to $25. And when the price goes from $15 to $25, look what happens to the supply by the local supplier. At the free trade price, which I've just drawn a square around at 15, the firm was supplying 2,000, but now at the higher price, the firm will supply 4,000. So the output of the firm grows from 2,000 to 4,000. So this represents growth for the local firm. We call this the protective effect. It's the protective effect. Why is it protecting the firm? It's protecting the firm because the firm's revenue at the world trade price was $15 times 2,000, the little green rectangle. But now, once the quota has been introduced, the price rises to $25. The firm produces 4,000, and so the firm is now earning the red rectangle. The firm's now earning the red rectangle. So it goes from the green rectangle to the red rectangle. So naturally, the local firm gains. The local firm gains out of this transaction. And we'll go up to the slide where we're now looking at the, we'll just clean this slide up a bit. We'll clean the slide up and think about what the level of imports were to start with, right? In free trade, what was the level of imports? The level of imports was 5,000. Then after the imposition of the quota, where we've moved the amount of imports into 2,000, the price has risen to $25, so the local firm is now producing 4,000. The local demanders are buying 6,000, so the level of imports is now 2,000. We can see the imports there. So originally it was 5,000, and then now it's 2,000. We've shown the red line between the two supply curves. It's the same distance when we mark it along the bottom axis. There's 2,000 units of imports. And then once we do that, let's think about then if we've restricted our level of imports, think about the result here now as far as consumers and producers and the surplus. Firstly, under free trade, I'm showing in black, under free trade at the world price, consumers bought 7,000, and we could show the consumer surplus by the black triangle. But once the quota is in place, and the level of imports moves in, at the new price, which is 25, consumers only buy 6,000, and so the consumer surplus is now the red triangle, and I'm just going to put 4 green dots here to show what the consumers have lost. The consumers have lost H, I, J, and K. H, I, J, and K. Is there anything new here? This diagram so far looks exactly the same to me as the tariff diagram. The price has gone up, the quantity of imports has gone down, and the consumer surplus has fallen by exactly the same amount. The only difference here is that what made it fall was this fall in the level of imports. We use that as the mechanism. All right, now let's think about the producer surplus. What was the original producer surplus? At $15 and $2,000, the tiny little triangle that I'm shading in here, that was the area of producer surplus, but now the producer surplus is bigger because now there's a new price. We come out to the supply curve, which is the marginal cost curve, and now we've got a bigger triangle. Area H has gone from the consumer surplus to the producer surplus. That's been transferred. Consumer surplus to the producer surplus. On your tariff diagram, you will remember that area J went to the government, right? That area J went to the government. Why did it go to the government? Because that's the new level of imports, 2,000, and the government was collecting a tariff. But now we've got a quota. So the government's not collecting a tariff. So who is going to gain from that? Who is going to gain from this transaction? Who's going to gain area J? Well, there's two possibilities here. So possibility one is this, the surviving importers. All right, surviving importers. Now, who are they? Well, we don't know, but we do know that originally, before the tariff, 5,000 imports were allowed in, and now there's a P in importer, isn't there? I've left it P out. But anyway, surviving importer, there was 5,000, now there's only 2,000. So some companies are not allowed to import anymore. They are losing out. But of course, the ones who survive, they gain because they're now getting a higher price for their product. They're now getting $25 rather than $15. So they're able to, they're paying $15 for the import, and then they're just able to put the price up another $10 because the domestic price has risen. So that they're able to raise price. That's one party that may gain. The other party that might gain, it could be the government. Now, the reason it could be the government is because before the quota, 5,000 imports were allowed in. Now there's only 2,000 imports are allowed in. So how does the government decide which importers can import? Because there are going to be less companies importing. How do they decide who gets to import? And one way they might do it is they might give a license. They might sell a license. So if you want to be one of these 2,000 people with the permission to import these goods, you might have to buy a license from the government, and maybe the government makes revenue from it. Maybe the government earns revenue from that transaction. So the diagram before you looks very much like the diagram that we used. It looks very much like the diagram that we used for tariffs. Very much like the diagram. The effect on consumer surplus. The effect on consumer surplus is the same. We can see that the consumer surplus falls from the black to the red, with the effect on the producer surplus is the same in that there's a new producer surplus and the producers now gain area H. Area J, who's going to gain area J? Maybe it's the surviving importers because they get to put the price up, or maybe it's the government who gets to charge them a license fee, or maybe it's a combination of both. The government might charge a license fee, but the firms may be able to put the price up by an even greater amount. So we can see that the total level of surplus is smaller because we still have these two areas here. Area I, that was part of the consumer surplus. Now it's no one surplus. And area K, I think it is, that is also part of no one surplus. So they represent the dead weight loss. And for that reason, we'd say that are quotas a good idea or a bad idea? Well, consumers lose. Consumers lose. Consumers lose because the price goes up and the quantity of consumption goes down. Producers win because the price goes up, so they get more for their product, and the quantity supplied for the protected firm goes up. And then how can the government gain? The government might gain if it sells an import license. Or maybe that gain simply goes, if they don't sell the import license and they just give it away to an importer, then that importing firm will gain because they get to put the price up. But the reason that the text finishes off with this line, therefore the quota is bad, is because of the lower overall surplus, the dead weight loss. Right, the lower total surplus, right, i.e. dead weight loss. So that's why we would argue against that. That's why the conventional argument is there against quotas. So that's the last slide in our presentation for topic. For chapter 6. So I'm going to move on to chapter 7 now. So I've opened up the slides for chapter 7. While I'm talking to you, maybe you can get into Moodle and open up the next chapter. We've got about 45 minutes to do this. So I'll get a little way into our next topic. Where we're going to start with this topic is that we're moving to a new part of the course. We're into the last 4 chapters. And for the first 4 or 5 chapters, we imagined that we were living in a world of perfect competition. What's the world of perfect competition like? Small firms in a big market. Firms have no control over price. The only choice they have to make is whether to produce and how much to produce, but they are price takers. The other thing about perfect competition is if firms are making profits in the short run, because there's no barriers to entry, new firms can enter the market so that in the long run, there is no economic profit. People just break square. What that means is they cover their costs of production and they also cover their opportunity cost. So we'd say that they don't make any economic profit above their opportunity cost. So these were the characteristics that we imagined in perfect competition. Over the next 4 chapters, we're going to be looking at at different forms of market or different occurrences in markets where these characteristics no longer hold. Perfect competition exists in a perfect world. There's no such thing as a perfect world, right? It's an economic model. Sometimes we get situations that look a bit close to it, but and we can certainly learn lessons about competition and elasticity, and we can learn broad economic lessons from the theory of perfect competition. But now we're looking at more real world situations. Today we're looking at monopoly. So if we transition back to our slides, I'm going to start with our assumptions of perfect competition. And then today, in monopoly, we're going to look at two characteristics that don't actually hold anymore. So let's get into these now. As I just said to you, imperfect competition imagines these things. Right? What does it imagine? It imagines firms are price takers. All right? It imagines that goods are homogeneous. It imagines there are no externalities. It imagines that goods are excludable and rival. We haven't really looked at this, but we'll do this when we get to chapter 10. We imagine that there's full information, perfect information, so everyone knows what the price is, everyone knows what the profit level is, everyone is fully informed about the market, and we assume that there is free entry and exit. Those are our assumptions for perfect competition. But then when we get to imperfect competition, which is what we're looking at in the next 4 chapters, we see that certain of our assumptions no longer hold. So what no longer holds now? What no longer holds is that firms, we say firms are not price takers anymore. Firms are not price takers. Firms are price makers. Firms can, in perfect competition, you can't choose the price, but in imperfect competition, you can choose the price. And the other thing that doesn't hold anymore is this idea of free entry and exit. In perfect competition, if firms are making a profit, other firms can see that profit and enter the market. That causes the price to fall, and that makes the economic profit be competed away. Eventually, that economic profit will not exist. So these are the two things that don't hold in monopoly, because firms are price makers and firms are not free to enter this business because there are barriers to entry. There are things that are stopping new firms, barriers. There are things that are stopping new firms from entering. So we're going to have a look in a minute about what those factors might be. So in this situation, firms are price setters. Let me show you what a price setter means. Price setter or price maker. Let me show you what that means. I'm going to draw in the left-hand diagram. I'm going to draw a little diagram. Right, price, quantity. And then in this situation, the firm has a downward sloping demand curve. It has a downward sloping demand curve. In perfect competition, you'll remember, the firm is part of the market. The market sets the price. The market sets the price, and the firms have no choice about the price. The only choice the firm has is where the marginal cost curve cuts that price line, and the only choice the firm has is to set the quantity. But in monopoly, it's different. The demand curve is downward sloping, which means that, what's it mean? It means this. that if I'm the monopolist and I want to raise the price from P, where I'm selling Q, I want to raise the price to P1, then I will sell Q1. As a monopolist, I cannot control both the price and the quantity. I can't do this, for example. I can't say, oh, I'm the monopolist, therefore I'm charging P1 and I'm selling Q1. That would put us out there where the green dot is. Now, why can't we be at the green dot? Because although the monopolist can set the price, they are only half the market. The other half of the market is the demander. So if the monopolist sets the price at P1, which I'm marking, it will be the demanders that decide to buy Q1. So they still have a demand curve. In this example before you, you can see that the firm can charge P1 or P2. Now, if they decide to change the price, then there will be a movement along the demand curve. They change the price, there's a movement along the demand curve. So this rise in the price, which I'm showing with a red arrow, the firm pays this. They have to give up demand. So we know that this firm is a price maker, but its market power is limited. It's limited because, yes, it has the ability to set its own price, but if the demander stops buying the product, it still has limited market power because it knows that if it raises the price too much, it's going to lose too much demand. I'm going to show you a firm that has more market power than the example on the left. What if the demand curve for the product looks like this? A much less elastic demand curve. Then the firm could raise the price. The firm could charge P1. Let's take the dot all the way over. The firm could charge P1 instead of P2. Let's take that dot all the way over. P2. There's a 2. At P2, they're selling Q2. At P1, they're selling Q1. You can see that the price rise in the situation on the right is much lower. It delivers a much lower fall in quantity. So the firm on the right-hand side has a lot more ability to raise the price. It has more market power here because when it raises the price, it loses a comparatively small amount of quantity demanded. And you can see in terms of its revenue, when it raises its price, it gets a new price shown by the black line, new quantity shown by the black line. It gets that revenue. And when it raises the price, it goes from the red rectangle at the low price and the higher quantity. You can see the red is much bigger. The black is much bigger than the red. So the firm has a lot of ability, a lot of market power. It has every incentive here to raise the price. So that's what market power is about. So all monopolies are not the same. All monopolies are not the same. A pure monopoly only has one seller. That's true. But do they all have the same market power? They don't. Because a monopoly who is controlling the petrol market, for example, petrol is a generally price inelastic good. So that firm will have a lot of market power because it knows it can push the price up and it won't lose many sales. But someone else that has the monopoly on ice cream or soft drink, Those products tend to be luxury items. They're not necessity generally, unless you're completely addicted to sugar. And so they have a more elastic demand curve. The firm may put the price up, but there may be no competition, but the consumer can always still choose not to buy the product. So although the firm may have a monopoly, its strength of market power really depends on the product that it's selling. All right, so back to our slides. All right, so we know that the firm has is a price maker. It has a downward slope, and we know that the firms have market power. Which firms are likely to have more market power? Well, a monopoly is going to have more market power than the others because we know that one determinant of elasticity is the level of competition. And because it's the only firm in the market, there's no real competition. There's no close competition for this product. And so that's one of the factors to do with elasticity. Now, as I said, there are other factors to do with elasticity, like whether the good is a necessity or whether it's a luxury. There are other factors, but certainly monopoly firms tend to have more market power than the other firms in imperfect competition. What would the demand curve look like in monopolistic competition? It'd still be a downward sloping demand curve, but because the goods are only slightly differentiated, there's a lot of competition. And so the demand curve is depending on how well the firm can differentiate its goods. Most firms in monopolistic competition will have highly elastic demand curves. They can still choose a price, but they haven't got the same power that the monopolists will generally have. Monopolists will tend to have steeper demand curves. Okay, now, what gives a firm market power? What allows a firm to have market power? Market power can come because a firm has control over the scarce resources. If a firm has control over the scarce resources, that means the firm with that control is the only firm that can really make the product. Without the resources, you can't make the product. So if a firm owns a key ingredient that goes into a specific product, then no other firm can make that product unless the monopoly sells them the resource. So that gives them a lot of control. Secondly, governments may create barriers to entry. They may do this in a number of ways. They might simply just give a license to a company, maybe because that company is well connected to the government. There may be some corruption involved with some of these monopolies. Sometimes the government owns the firm themselves, and so they don't want anyone else competing with them in the market. Or sometimes the legal system gives firms monopoly power because, for example, if a firm invents a product, it has the patent, it has the only right to make that product for a certain number of years because it's the inventor of the product and it's registered its patent, and that gives it its intellectual property right. Also, things like copyright over artistic works or licenses from government, they will also restrict the entry. Returns to scale often give firms, big firms, an advantage. So increasing returns to scale give advantages to big firms, and also network economies. I'm going to talk to you about those two things. So on our slide, our last two characteristics to do with market power are returns to scale and economies of scale. We're going to get into the long run here, and so I don't want to drill down into returns to scale too much, except to say this. Sometimes when firms get bigger, imagine a firm that has a given size of factory, a given size of its infrastructure, and then it decides to double it. So it doubles the size of the factory. Very often what happens when that occurs is that they've doubled the input size, they've doubled the size of the factory, but the output increases by more than double. So we might imagine a firm doubles its investment into its infrastructure, but its output actually triples or quadruples. So the output grows faster than the input. And if the output is growing faster than the input, then the firm is getting what we call economies of scale. In other words, economy meaning cheaper and scale meaning bigger. So when you get economies of scale, you're basically seeing a situation where bigger is cheaper. So in Australia, where we used to have car factories here, we don't have them here anymore. But if something like, I saw an example, I think it had to do with refrigerators or washing machines that we were making here, and we were making washing machines on a scale of about 50,000 a year. But then in America, the big firms in America like Westinghouse, they weren't making 50,000, they were making 2 million. And so they're operating on a much bigger scale. And as a result of that, we could call it mass production, right? We could call it increasing returns to scale. Whatever we call it, bigger becomes cheaper. And the reason bigger often becomes cheaper is this. If you think about another product, not washing machines, think about a product like Coca-Cola. To build a factory costs a lot of money. But when they start producing cans of Coca-Cola, that factory has a huge potential scale. They might be able to produce 1,000 cans, but they can also produce 1,000,000 cans. And each time they produce an extra can of Coca-Cola, what's going into the can? A little bit of tin foil that makes the can, and a little bit of sugar and other stuff that goes in to make the Coca-Cola. But that marginal cost of each Coca-Cola is probably very low. And so although they've invested a lot in the factory, when they produce more and more and more cans of Coca-Cola, they're averaging that factory cost, which is a fixed cost, over a greater and greater and greater output. So as the scale of the output gets larger and larger and larger, the fixed input cost is divided by a greater and greater and greater amount, and therefore the average cost will be falling. So that's what we mean by economies of scale. Economies of scale come about because of increasing returns to scale, which means the ratio of outputs to inputs grows as the firm gets bigger. So that's the second last point. And what that means is big companies tend to produce cheaply. And because big companies can produce cheaply, a new little company wanting to come into the market finds it very hard to compete against a big company that has a big scale, mass production, low production cost. So imagine someone wants to open up a boutique brewery and they're thinking, how many cans are we going to sell this year? Well, maybe we might be lucky. We might sell 20,000. Maybe we sell 50,000. But then if they're up against a big brewery like Carlton United or someone who are producing probably 100 million cans, it's very hard for that small firm to come into the market. And so that's why the big firm has the barrier of entry to the little firm, because the little firm's costs, particularly at the start, are going to be higher. And so the little firm might decide, we just can't do it. It's too expensive and we just can't compete against the big firm. So that creates a barrier to entry. The other example, the other thing on the list creating a barrier is what is called network economies. The way network economies occur is this. In some products, the value of a product to the consumer exists because there are a lot of other consumers like them. So an example of this might be Instagram or Facebook. Now, if you are on Facebook, the value of Facebook to you is useless if you don't have any friends on Facebook, right? The whole point of you being on Facebook or Instagram or any other network is that there's lots of other people on the network. So if a big firm already exists and lots of customers already have their network on your network, right? If your social network is all on Instagram, then you moving over to some other platform, that's useless to you unless all your friends move as well. So it's very hard for new firms to start up because people already have, there's already very strong network economies existing on the existing platform. So that will create a barrier to entry for new entrants. It doesn't mean that new social networks won't open up. They might open up, but they'll usually do it because they have some new feature that suddenly is appealing to the general population, and people quickly jump on. But network economies do provide the existing big firm with a barrier to entry to new firms. So that's where barriers to entry come from. Where there are barriers to entry, demand tends to be, there's less competition, and therefore demand tends to be inelastic, and that's what gives the firm market power. All right, we'll go back to our slides. So we've already looked at this idea of increasing returns to scale, and what that tends to result in. What that tends to result in is the average cost of producing certain goods decreases with the amount of the good produced. Now, where that average cost decreases, we call this an economy of scale. And increasing returns to scale will produce for you an economy of scale. And what's the economy of scale actually mean? It means your average total cost is falling when your output rises, right? So it decreases with the amount of goods produced, right? The average total cost falls when the output rises. We'll just read through this slide quickly, then I'm going to draw you a diagram. So there's our increasing returns to scale. A single firm producing a large quantity of good can do so more efficiently, right? Lower average cost, average total cost, and then a number of small firms competing. Because if we have a number of small firms, these small firms, they don't get economies of scale, right? So the small firms, they don't get economies of scale because they don't have scale. So what is this slide all about? What this slide is about is this. If we have one big firm that has a lower average total cost than a number of small firms, what this means is that monopoly may actually have the best potential deal for consumers. Because if you can get one large firm with a low average cost, and then that low average cost becomes a low price, it might be actually better to have a monopoly even though there's no competition, because that the economy of scale cancels out the advantage of competition. So this is called the natural monopoly. So what's the natural part about it? The natural is that normally monopoly is not competitive and firms are able to abuse their monopoly power, put prices up, but sometimes a monopoly may result in a lower price, and under those circumstances, we could say it's naturally more efficient to have a monopoly than to have competition. Normally that's not the case, but sometimes it is. All right, so naturally monopoly occurs because of increasing returns to scale. I'm going to draw a little example for you to show what we mean by the idea of a natural monopoly. So let's have a look at this. We'll do this diagram a number of times in over the next week. Here's price, here's the quantity. And I imagine that we are dealing with a telephone business, right? We're dealing with a telecom business. So this business is in the business of providing telephone calls. And of course, to set up a telephone network costs a lot of money. You need towers on top of roofs all over the city, and you need very advanced IT, computer systems and mainframes, etc., exchanges to connect one phone to the next. So imagine that in order to build this telephone system, it costs $1 billion. $1 billion. And then we make one phone call on the system. What's the average cost of that phone call? Well, $1 billion, a very expensive phone call. But we're not going to make one phone call. What if we make 1 million phone calls, right? What if we make 1 million phone calls? Now the cost of that 1 million phone calls is still expensive, right? It's $1,000 each, right? It's $1,000 a phone call when we make 1 million. But if we make 10 million, well, the phone call now costs $100. If we make 100 billion, then if we make 1 billion phone calls, the average cost is now $1. If we make, so that was 1 billion. If we make 10 billion, the cost of the phone call is now 10 cents. So as our scale of production gets bigger, one phone call, then 1 million, then 10 million, 100 million, etc., the average cost is falling. Right? The average total cost is falling because essentially what you're doing is putting the $1 billion over more and more phone calls. So that's the average total cost curve. And we need another cost curve in here. The other cost curve we're going to put in is the marginal cost curve. Think about the marginal cost curve. All right, think about the marginal cost curve. Imagine that we have already made 1 billion phone calls, and then you pick up your phone and make a phone call. You are phone call number 1,000,000,001. how much does that add to the total level of cost to the firm? Your phone call. A tiny little bit of electricity somewhere in the system, somewhere that maybe your account will get adjusted. Probably not, because we have, plans with unlimited calls anyway. The cost to the phone company is probably so low that it would be hard to measure. So the marginal cost, each time someone makes an extra phone call, this marginal cost is very low and isn't rising. Right, another phone call, 0.1 of a cent, another phone call, 0.1 of a cent, another phone call, 0.1 of a cent. Very, very low marginal cost. This is what a natural monopoly looks like. So when we think about a natural monopoly, what we're thinking about is this: a large fixed cost and a small marginal cost. Large fixed cost, small marginal cost. In the examples that we've done before, I don't know how this slide got in there. In the examples that we've done before, your marginal cost curve looked like this. Our average cost curve looked like that, average total cost, and the marginal cost looked like this. That was in perfect competition. Right? That was in perfect competition. But in monopoly, in a natural monopoly, the average total cost curve is looking like this, right? Average total cost. And the marginal cost is looking like so. That's the example in monopoly. So why are they different? Why are the curves different for monopoly and perfect competition? The reason is this. In perfect competition, our marginal cost curve sloped up, right? It sloped up. And the reason it sloped up is because we were thinking about small businesses where each time you added a worker into the business, their marginal output got lower, right? Each progressive worker produced less, and therefore, and the reason it got lower is because they were starting to crowd out the fixed input. So if we add more and more waiting staff into a restaurant, each worker becomes less efficient than the one before because the restaurant becomes crowded and the capacity of the restaurant is limited. But in the case of a natural monopoly, so the example we just did with the telecom, the capacity of the telecom system is huge. So that system is not going to become crowded out in the same way that a restaurant is going to become crowded out. It's not going to become crowded out when we make 1 million phone calls. It's not going to become crowded out when we make 10 million phone calls. It'll ultimately become crowded out, but it'll be at a very, very high output. And therefore, we don't get that issue of rising marginal cost, because rising marginal cost ultimately comes around because the fixed input is being you're coming up against the capacity of the fixed input. The fixed input has a limited capacity, and as you approach that capacity, it's harder and harder to expand your output. But with a telecom system, it's easy to expand your output. Just pick up the phone and make another phone call, and you won't exhaust the system. Ultimately, every system will be crowded out. But if we think about another natural monopoly, think about a railway system in a big city like Sydney. Costs a lot of money, big fixed cost to build the railway system. But when one extra passenger steps onto the train, how much extra cost is there to the train system? There's very little extra cost. A little bit of wear and tear on the floor, very hard to measure, so close. A little bit of cleaning fee probably. But, tickets, buy your tickets online, etc. Very low cost to get another passenger on the train. And the train network has a very large capacity. Ultimately, yes, it will be crowded out, but in the range of output that we're going to be considering, we're not going to reach that capacity. So that is why the natural monopoly looks different to the small firm in perfect competition, because of the very large capacity of the fixed input and the difficulty in then crowding that fixed input out. So that's the explanation of why this curve looks a little bit different. All right, so we've dealt with the natural monopoly. I'm now going to do this with you. Okay, so we now got some numbers in front of us, and I'm just going to, what I'm going to do today is just get down to our idea of the total cost. So where I'm heading to, this is going to take about five minutes. I'm heading to there. So let's start with what's going on in our table in the first two columns. We've got workers and we've got the quantity that they produce. And the thing that I want you to notice here that's different to when we did perfect competition is that these units are growing by a constant amount. When we did perfect competition, as we added each progressive worker, the quantity did get bigger, but the growth in the quantity kept falling. In other words, we came up against the law of diminishing returns. Here, we're not up against the law of diminishing returns. What we're seeing is that the marginal output is 200, 200, 200, 200, all the way down. So we've got a constant marginal output. When we see a column, when we see something like that, we know that the law of diminishing returns is not applying here. And the reason the law of diminishing returns is not applying here is because this fixed input probably has a capacity of thousands, right? Not 1,000. It may have a capacity of 5,000 or 20,000. So we can keep adding, as we keep adding workers, each extra worker simply adds the same 200 units. So the marginal output there is 200. It's a very bad attempt to write 200. I won't even bother, but you can see that each time we add a worker, there is a constant, right? There's a constant marginal output. There's a constant marginal output. And that constant marginal output is 200. And if I can just jump ahead, I'll do this more thoroughly on Tuesday, but that constant marginal output is going to mean we're also going to have, as a result of that constant marginal output, a constant marginal cost. We'll get to that on Tuesday. But as I said to you before, in perfect competition, you have a marginal cost that goes up like so, but in monopoly, you have a constant marginal cost, 5 cents, 5 cents, 5 cents, 5 cents. That is the link between those two. The constant marginal output leads to the constant marginal cost. In any case, I'm going to clean this bit of writing up. What I want you to see then is this, that we have a fixed cost, we have a variable cost. Let's start with the fixed cost. So here's our fixed cost. Our fixed cost is $100, even if we're producing nothing, because that's the nature of a fixed cost. So we've spent $100 on our factory. And then if I want to know what the average fixed cost is, all I do is I say, well, here's the fixed cost. The fixed cost is $100. Right, there's the $100, and I put that over my quantity, right, divided by 200, and there we go. There's 5 cents. But then when we expand our output, think about what's happening to our fixed cost. If we come down to the bottom line, I have the same fixed cost, but I'm now dividing it by 1,000. So now our cost is 10 cents. So you can see that this is where the shape of our natural monopoly average cost curve is coming from. It's getting lower and lower and lower because so much of our cost is fixed cost. And then if we want to then look at our variable cost, which we'll change colour for, our variable cost involves us paying each worker $10 a day. So one worker times $10 equals $10. 5 workers times $10 is $50. So there is our cost of our workers. And then if we want to think about our variable cost per unit, what's our variable cost per unit? Our variable cost per unit is this. Cost of a worker is $100. There's the worker. Sorry, cost of the worker is not $100. Cost of the worker is $10. Right, that's the cost of a worker. And then I just put that over 200 units. Why am I putting 200 units? Because each worker is producing 200 units. And so each worker, the average variable cost is 5 cents a unit. And the total cost is this. Imagine that these are cans of soft drink. The variable cost of the soft drink is 5 cents a can. That's the variable cost. That's the cost of the worker in the soft drink. And then what's the 50 cents? That's the size of that's the price of the factory in the soft drink. The total cost is 55 cents. When we get down to the bottom line, we do this in blue, the cost of the worker in the soft drink is still 5 cents, but the cost of the factory is not 50 cents anymore, it's 10 cents. And so you can see that the total cost goes from 55 down to 15. Why is it going from 55 down to 15? Because the average fixed cost is falling. The cost of the factory per unit is falling. And as I said before, that explains the downward slope of the average cost curve in a natural monopoly. So it's now 9 minutes to 1 o'clock, so I'm going to finish the lecture here. I'm going to finish on Tuesday. I'll start with the marginal cost. We start on the same table, and then we'll then redraw the diagram that I drew for you before, and we'll just then fill in some numbers on that diagram. So that's the end of the lecture. Have a good Easter break, and I will see everyone on Tuesday. Thanks very much.